Valuing a business accurately is so crucial to ensure that you're paying a fair price and getting a return on your investment for the business that you're going to acquire. The value of a business isn't just based on its current financials, it's also going to include adjustments for future earnings, assets, and intangible qualities like reputation and customer loyalty. This section is going to walk you through the different methods that we use to do valuation and how to negotiate the purchase price and importance of goodwill and intangible assets. The first method used is the EBITDA multiple method or earnings multiple method. Here, the earnings multiple method values a business based on a multiple of its earnings before interest, taxes, depreciation, and amortization, or EBITDA. This method is popular because it focuses on a business's profitability and cash flow. EBITDA is a key measure of operational performance, and EBITDA shows how much cash the business generates from its core operations. Multiples. The multiple applied depends on factors such as industry, size, and market conditions. For instance, businesses in high-growth industries may have higher multiples of 4 or 5x, while more stable but slower-growing businesses may have lower multiples, 2 or 3 times EBITDA. The pros of this method is that it's pretty straightforward, and it focuses on the profitability and earnings potential of the business. The cons are it doesn't account for the business's assets or liabilities and can sometimes be overly simplistic for complex businesses. The next method is the discounted cash flow or DCF method. The discounted cash flow method values a business based on its projected future cash flows, discounted back to present value. This method is particularly useful for businesses with predictable cash flows or when long-term growth is expected. Cash flow projections. You must forecast a business's cash flows for the next 3 to 5 years, accounting for growth rates, expenses, and market conditions. You need a discount rate, and this discount rate reflects the risk associated with the business and the expected rate of return. Higher risk translates to a higher discount rate, lowering future cash flows at the present value. The pros of this method is that DCF is a highly detailed method that factors in the business's future earnings potential and the time value of money. Cons are it requires reliable cash flow projections, which can be challenging to estimate accurately, especially for businesses in volatile industries. The third valuation technique is the asset-based approach. This method values a business based on the total value of the assets minus its liabilities. It's typically used for businesses with significant tangible assets, such as manufacturing firms or real estate firms. You need a book value and market value to do this. And you can use the book value, which is the value of assets as recorded on the balance sheet, or the market value, the current asset price. You're going to need the net asset value, which is where you subtract liabilities from the total asset value to get the net asset value of the business. Pros of this are that this method is ideal for asset-heavy businesses and provides a clear understanding of the business's tangible value. Cons are that this method doesn't account for intangible assets like brand value or customer relationships, which can be key for many businesses.